All right, let's talk about something that sounds, well, boring. The boring millionaire portfolio. But what if I told you that boring might just be the most exciting and powerful way to build real, long-term wealth? Today, we're going to break down exactly why.
And let's just kick things off with this bombshell from the legendary Charlie Munger. What he's getting at here is a massive problem in the investing world. Almost nobody, we're talking 95% of professional fund managers, can consistently beat the market average, especially after you account for their hefty fees. This really sets the stage for why we need a totally different approach.
So, here's what we're going to cover. First, we'll hit the big paradox at the heart of investing. Then we'll dive into the simple solution, the three-fund portfolio. We'll show you exactly why it works, how to build your own, and then get into the really crucial part, the psychology you need to actually stick with it.
Okay, let's jump right in. The millionaire's paradox. The entire financial industry wants you to believe that investing is incredibly complicated, right? That you need some kind of Wall Street genius to manage your money. But here's the paradox. The data overwhelmingly shows that the simplest, cheapest strategy is the one that wins in the long run.
And this slide just lays it all out side by side. On one hand, you have the chaotic world of active management, trying to pick the next hot stock, paying high fees, constant trading. It's a game that almost everyone loses over time. But on the other hand, you have the calm, disciplined three-fund strategy. The goal here isn't to beat the market, it's simply to be the market and let the market's growth work for you.
So what is this beautifully simple solution? Well, it all goes back to the core philosophy of the legendary founder of Vanguard, John Bogle. It's all about the three-fund portfolio.
So what is this thing really? It's exactly what it sounds like. It's a strategy of pure simplicity. You're not trying to find a needle in a haystack by picking individual stocks. No, you're buying the whole haystack with just 3 ingredients. One fund for US stocks, one for the rest of the world stocks, and one for bonds. That's it.
And this idea comes straight from the man himself, Jack Bogle. He was a huge believer that complexity is the average investor's worst enemy. Why? Because complexity is often just a way to hide sky-high fees and encourage you to make bad, emotional decisions with your money.
You know, I love this cake analogy. It just makes so much sense, right? You take 3 basic, simple ingredients, but when you combine them in the right way, you get something incredibly powerful, a globally diversified portfolio that owns a piece of almost every public company on Earth. Okay, so it sounds nice. It sounds elegant. But does boring actually win? Does it perform better? Oh yeah. Let's look at the hard data, because this is where the whole thing goes from a neat idea to a mathematical knockout.
This is the question. This is the silent killer of wealth that most people just ignore. We see a 1% fee and think, what's 1%? But over decades of compounding, oh boy, that tiny number becomes a monster. The answer is honestly shocking.
Okay, just look at these numbers. Brace yourself. That tiny 1% fee on $1 million portfolio over 30 years. It costs you over $1.7 million in lost growth compared to the low-cost strategy. Let me say that again, $1.7 million. That's not a typo. That's the price you pay for the privilege of likely underperforming the market anyway. It's insane.
Okay, so this is a really common question. You might be thinking, hey, the S&P 500 does great. It's simple. Why bother with international stocks and bonds? And you know what? It's a fair question. But history shows us that putting all your eggs in one country's basket can be way, way riskier than you think.
And boom! Here's why. This chart tells a crazy story. Look at the period from 2000 to 2009. They call it the lost decade for U.S. stocks. If you were a retiree pulling money out of a 100% S&P 500 portfolio, you got absolutely crushed. Your $1 million was cut by more than half. But the diversified three-fund portfolio, it didn't just survive, it actually grew. That right there is the awesome power of true diversification.
All right, so if you're on board, you're probably asking, okay, this sounds great. How do I actually do it? Let's get practical. This is where the rubber meets the road. And the best part is, it's so easy. Here are the literal fund tickers you can use at pretty much any major brokerage. Vanguard, Fidelity, Schwab. They all have these dirt cheap, total market index funds. You could set this entire thing up in about 15 minutes. And look, Fidelity even has funds with a 0% expense ratio. 0. Now, this is super important. The recipe you see on the screen, that's just an example. This is not a one-size-fits-all deal. The biggest decision you have to make is figuring out these percentages for yourself based on how old you are and how much risk you're comfortable with.
A really simple starting point is the your age in bonds rule of thumb. If you're 30, you might have 30% in bonds. If you're 60, you might have 60%.
It's a simple way to create a glide path that automatically gets more conservative and protects your money as you get closer to needing it in retirement.
Okay, so building the portfolio, that's the easy part. I'm serious. The truly difficult part is winning the battle that happens next, the one inside your own head. So let's talk about the massive psychological advantage of being a boring investor.
Look, we are all hardwired to make a few classic investing mistakes. We chase performance, buying things after they've already gone up. We panic and sell when the market drops, locking in our losses. We think a complicated strategy must be a smart one. This simple three-fund portfolio is designed to be a powerful antidote to all of those wealth-destroying urges.
And that's really the whole point, isn't it? This isn't just an investment strategy. It's a behavioral strategy. The goal is to build a portfolio that lets you sleep well at night. Its simplicity helps you tune out the noise, ignore the scary headlines, and avoid making those gut reaction decisions that can wreck your future.
Which brings us to our final and maybe most critical section. At the end of the day, your biggest opponent in investing isn't the stock market. It's not Wall Street. It's the person staring back at you in the mirror.
The entire path, the whole secret to becoming a boring millionaire, it just boils down to these 4 incredibly simple, disciplined steps. Build the portfolio. Automate your contributions so you don't have to think about it. Check in once a year to rebalance. And, this is the hardest one, stay the course. Just leave it alone and let time and compounding do their magic.
So, that's it. The market is always going to be crazy. It's going to be unpredictable. That is a given. But your behavior, that's the one thing you can actually control. So the final question is pretty simple. Are you ready to be boring to achieve some pretty extraordinary results?